Okay, hello everybody. This is the Option Professor speaking to you today. We're going to have an hour right now where I'm going to be going over some of my favorite technical indicators. But before we get started, I always start out by saying, remember that we are going to be sharing our opinions and our observations, and that what we are not giving out here is advice, because obviously we don't know your circumstances. So obviously we can't give advice out to people. With regards to what you should be doing is consulting your brokerage firm and your broker to discuss your risk tolerance and your suitability. And you guys all should be making that decision on your own. With regards to past performance, not indicative of future results. And again, we're giving stuff here out for informational purposes only. Okay, having said that, let's get into what we're talking about here, which is our technical indicators. The market really got slapped here today, but it really is not a surprise to us. If you've been getting our regular reports for the last couple of years, you know, we did tell you that the bond market peaked and what we thought is a cyclical peak back in March of 2020 when the 10-year went to 0.36. We don't think that's going to be seen for many, many, many years. Anything could happen, but you know, if there was a probability of it not happening again, that would be a yield we won't see. It's the end of a big cycle that started back with Volcker when he had the interest rates up at 16%, and we had declining interest rates overall for 40 years. And now that cycle is done. With regards, so if their yields are rising overall, at some point that wears out on equity. So in 2021, we told everybody that we thought that there was a cyclical high in the S&P around 4,800. Nasdaq, whatever that was. And so far, so good as far as not taking out those highs. So again, as we've been trying to explain to people, the Fed is withdrawing liquidity because they obviously pumped it up way too much. They did a great job, you know, obviously getting us out of COVID. They did such a great job that inflation's going nuts. And obviously the yields have to rise to slow things down. That's the big picture. Now, today we're going to start looking at the smaller picture. The last part of the picture, by the way, is, again, we've said that the peak in the bond market was in 2020. We said the peak in the stock market is 2021. And we are saying that we are looking for the peak in commodities in 2022. So 2 out of the 3 have already seemed to have happened, because if you look at most stocks, they did peak in 2021. And then basically, as far as the commodities, boy, would you be shocked if this is the high on the commodities this year with the kind of prices that are going around? So that's the one we're keeping an eye out on. And I'm going to talk about a few of the stocks that have really gone through the roof that might be vulnerable if, in fact, that scenario of a top in commodities is correct. Okay. By the way, a quick background on myself. I've been doing this for decades and decades. I've educated thousands upon thousands of investors nationwide on the uses and risks of options. I'm very versed in all different investments, from the stock and bonds to commodities to, you know, options, obviously, and currencies. So I'm pretty familiar with the whole 9 yards. Okay. So let's go over here and let's look at some of the macro stuff on the big stuff, and we'll talk about our technical indicators. Okay, when I look at things, I like to look at things on a different time frame basis. So in other words, right now I'm looking at a 20-year. I'll look at a 20-year. And basically, then I'm going to look at a 5-year, then I'm looking at 1 year, then I'm looking at 1 month. Okay. I don't really go much under 1 month unless something is very, very concerning to me. And I'm looking at something to crack, and I'm looking for the first indication that it's cracking. But generally, those are the time frames I look at. All right. So right now, you can see that the S&P has, you know, these moving averages. I'm using a 10 and a 20 on this particular chart. And then I'm going to get into other charts that I use as well. But get this, we're looking at a rising moving average ever since 2009. So you have the bottom, and look, that average is rising pretty much the whole time. That's important, because if you violate a moving average, but the moving average is rising, and then you get right back above it, that trend is continuing. And as you can see, that's exactly what happened. So right now we're still in an uptrend, and we'd like it to stay above the lows. So obviously the lows of February are really important. Guys like Tom Lee says the lows are in. You know, he doesn't know. Nobody knows. But, you know, that's his bet. And, you know, his bet is backed a little bit by at least this moving average. So, I mean, you know, I don't think he's crazy to say that. But, you know, we'll have to see, because, again, taking away liquidity generally is not positive for the stock market. All right. So anyway, there you go. You got some support on there at around 41.50. and you got some resistance at 4,500. That's why when it went through 4,500 today, if it would have stayed above that, that would have been fantastic because you would have been above 44.92. But you're not above 44.92 when they took it home. When they took it home, you're at 43.89 and the thing is going in the toilet. So can you see why this average is kind of important? Because they peaked it through, but they couldn't keep it above. And that's a negative. That's a negative. Okay. So again, once it got underneath the high point here that we had of 44.92 today, that was your indication that Rome was going to start burning. And certainly it burned pretty good in the afternoon. Now let's look at it on a 5-year basis. 5-year basis, again, you know, this 44.93, what was the other one? 44.92. Those are big numbers. And if we can close above that, you know, then you can start really entertaining the concept that you know, the lows are in and we're probably going to go up towards that 5,000 mark. But, you know, in my view, you can't do that yet. And where's the RSI here? It's right around 50. So we're at a very critical time. If this thing starts going into the tank and starts testing 4,100 and this RSI at 51 starts getting underneath, you know, you could get into a situation where it looks like not 2020 maybe, but at least 2018. And that's a 20%, 25% drop off the high. Now, if we were high at 4,800 and you went 20% down, you'd go down to 3,840. Listen, if we take out 4,100, of course, we're probably going to break 4,000. So 3,600, and I'll show you other numbers that we're working with that could back that. But right now, you have to be very concerned that that although the earnings are coming out pretty good, they're being met with selling, which basically means what? Hey, you did a great job, great numbers, but your guidance stinks, or we're telling you your guidance is not going to be as good. And that's the kind of price action you don't want to see. Great reports, bad price action. And that's what you've been seeing. And that's the problem. So anyway, the 5-year graph, you know, looks pretty dodgy as well. Next one is the 1-year graph. And there you go. It's across to the downside. Again, the number up here was around 44.88. So that 44.90 neighborhood was very important for it to stay above. And we hit 45.09 today, but boy, did they not, they took it off on a little bit of a low. So again, getting back above this number here, which is 44.38 would be nice. So keep an eye on that number if you're short-term trading. And on the monthly, you probably got a great sell signal today. Of course you did. Yeah, gave you the sell signal right in that neighborhood, 44.80, 44.90. That's your sell right there. And the RSI broke 50, no good. And that's why you got the big meltdown here. Okay. Of course, with that kind of a meltdown, it could bounce. But the bottom line is that, you know, that's a trend. That's a 1-month trend that definitely broke. Now we'll have to see. Could it be like here where it goes right back up again? Maybe. But right now, it's not a good looking market. Okay, let's take a look at the QQQs. You know, a lot of people have 9 million indicators. I've been in this thing for decades. I'm not saying my way is right, but in my opinion, less is more. You know, you can analysis through paralysis or vice versa, whatever they say. Okay, let's talk about the Qs. This is your Nasdaq stocks. Let's see what it looks like. Okay, down pretty hard, 7 points, 334. This thing really looks like a 360 market is the area where it's problematic for it. Let's take a look at the 20-year. Okay, big run up, big run up. Again, they haven't crossed yet, but that takes time. But again, it went up to the top. I told you like that 368, right? What was the high? 369 today. So as soon as it went up there and then it got back under 368.60, that was your indication that the thing was not going to be able to hold. Now the bottom part is at around 341. So getting back above 341 would be very, very constructive. But right now that's not the case. We're at 333. Where's your RSI? Your RSI is pointing straight down at 60. Okay, so again, 60 is a big number for it to hold too. Can you see it's been holding on a long-term basis? That's 60 RSI. So if it breaks under 60 on the RSI, more than likely you're going to blow out 316. And we'll look at some other charts that might give you a price to look for. But, you know, you break 60 on the RSI, it would be the first time you broke 60 since 2011. So that's a pretty big statement. So let's keep an eye to see if this thing breaks 60 on the RSI, because that would be a statement telling you that you're in more of a longer term bearish situation. Looking at the 5-year, well, it looks pretty negative, right? So again, looking for higher prices when the Fed is withdrawing equity is a rough racket, and you might get rallies like we've seen. But if you're not nimble and get out on the rally, you could get caught in the rain. And that's basically what's happening to people today. RSI is under 50. That can't be a good sign. So again, RSI is not looking good on the 5-year, and the other one is not looking any good on the 5-year either. Doesn't mean things can't change, but we only work off what we know. Okay, and what we know right now is the prices are on the defensive. You don't have to be a genius to figure out why we like to use these. When the trends are up, like over here, between May of 21, you were going up, up, and up. You got a nice dip, then it came back up, got a little choppy, and then bam. So on a 1-month basis, where'd you get the sell signal today? Well, it looks like you got a couple of sell signals. You got one there, and then you got another one down here. So you've been in and out of this thing a couple of times, but certainly you had a nice ride from 360 all the way down here towards 340. And the RSI obviously looks lousy the whole time. So after this little rally up, this was really the best place to sell right here, which was where around 364. Why is that? Because this is the first time you broke under 50 on the RSI. And once you did that, that's when it goes in. And then when it stays under there, that means you got a weak market. Tried to rally here, but the RSI couldn't get above 50. Came back down, tried to rally again. RSI couldn't get above 50. So those are just opportunities to hit it. Okay, let's look at the Russell. We'll use IWM for that. These are your small caps. These are the ones I kind of look at, to get the broad picture. So the over-the-counter, the tech and all that stuff, boom, you're in the growth, you're in the Qs. Big cap, you look at S&P and, big FANG. And then this is for your small caps. Okay, let's go to 20 years and see what's going on. Okay, well, like I say, it tried to make a run here because it went up towards 208, 209. And where are your averages? 214 and 207. So that's your resistance right there. What did it do today? Went up to 209, not too far, went through 207 a little bit, but didn't like the altitude. But all of these things peak through those numbers. And sometimes they peak through numbers to gather stops or to get people going to buy in. And then, there's people who can sell it to them. So that's why where they take the prices home is always important. And does it close above or below the averages? Because sometimes they penetrate the averages, but they can't change the trend. Okay, so there you are on that. Again, you would say it doesn't look very good. RSI, still above 55 though, so that's not so bad. How about we do it on the 5-year, see what's going on there. Yeah, it looks terrible. RSI is under 50. And it cannot, stay above the moving averages. Where are the moving averages on the 5-year? They come in at 206 ballpark and 202. So, that's where you want it to stay and get above, because then these averages can turn up. And if the averages turn up, then the RSI can get above 50. Right now, you can see when the RSI is above 50, you got a strong market. I'm using a 28 RSI, which is different than the 14. Why? It's smoother than, it's a little less sensitive, so it's a little smoother. Okay, so anyway, there you go with the RSI there, obviously. And again, one of the things we've been telling people is to get our PDF report on hedging against downside risk and upside surprises. The reason we're doing that, as you can see, if you had hedges on during these big drops, you would be a happier person. Or if you get very negative near the bottom and you hedge against an up move, you'd be a happier person. So learning how to use the options as a hedging device, not just a gambling tool, is very important. And that's why we encourage people to get this information. Again, I've been involved with this type of stuff for decades, so it's a second language to me. Okay, so that's where we are on the 5-year. How are we doing on the 1-year with the Russell? Well, again, turned down on the RSI, so that's not a good sign. Went up towards the high end, which again is that 203, 198 area. So again, if we can start getting above 198 and 203, it would start getting me a little bit more optimistic. Certainly, if we can take out 211, then you're back on the upswing. But that's a lot of ifs. Right now, that's not what's happening. Let's take a look at the 1 month. You probably got a good sell signal today somewhere. Yeah, it's kind of like, it was sloppy like the Nasdaq was. So anyway, you got a good, where's the RSI? Okay, the RSI was pretty much going negative right around here, which is 208. That's not a bad place to sell. And it kind of tried to go positive, but didn't. So here it went positive. So you got in there a little bit, but that's a nice little pop from 200 to 204. Again, this is short-term swing trading, day trading. And then, of course, you're back on the sell once it broke under 50, and that's right around the 202, 203 area. So not too much great to say about this stuff right now. I'm from the school of I'd rather see momentum and jump on a train that's going someplace than to try to buy the absolute turning point. So the bottom line is that, people might want to buy it down here because it's kind of testing the 196 area. Well, that could work. But again, until it gets above these averages and the RSI gets above 50, the potential might not be so great. So I'd rather get some other confirming indicators rather than just playing the prices right, because you just never know. All right, so we got the Russell out of the way. We got the Nasdaq, and we've got the S&P. Now, the other thing I'd like to look at, which is kind of old school, is the transports. The idea for me is that the transports give an idea of goods and services being moved around and how the economy is doing for all those goods and services. And, if the transportation stocks are going in the tank, I don't think that's a good thing for the general market. I think if the transportation stocks are really strong, that's an underpinning to the market, because again, it's goods and services and travel and everything else. So let's take a look here on a 20-year basis and see what it's telling us. And it's right on the ledge. It's right on the ledge here. You see, you want the IYT, which is the transportation ETF, to stay above 247. It's above 247. So, a guy who wanted to take a shot at it and use a get out point at 247, I could understand that. If it got above 259 and change, then I think it might be something to, to start looking at again. Because again, you would think if the consumer, which supposedly, according to B of A, is out there with plenty of money in the bank, a lot of credit card abilities, spending money, and in great shape, then they're going to need products and services to buy. And, the transportation guys, get all that stuff to them. So, if in fact this is going to be a stronger economy than people think, the consumer spending is not going to back off despite energy prices, despite higher cost of living, then maybe there's something here. So I'd watch the transports very closely here. Let's see if the other ones confirm it. But right now, 247 would be my line in the sand on that one. Turning to the 5-year. Again, still in rough shape, but again, try to keep it above 255 and 261. And RSI is trying to get through 50. So, it's very close right now at 49. So keep an eye on the transports. That could be a sneaky one that people aren't thinking about. And, if you, well, anyway, that's the one right there. Let's talk about the 1-year graph. Okay. And the 1-year graph, staying above 245 is going to be key, and getting above 255 is key. And the RSI is still under 50. So I wouldn't trust it right now as far as that's concerned. Again, if it can hold 247 and it can start giving you better prints like above 255, or at least hold above 246. See, 246, 247, if you can hold above there, then this average will start moving up. And that'll be a positive. But the RSI being under 50, it would be something that would make me not interested, because I definitely want the thing above 50 if I'm going to be bullish. Turning towards 1 month. Yeah, you see it's turning back up a little bit. It's trying to hang in there. So there's reason, again, to be long this thing with a get out at 247 ballpark. 245 is the low here. But, I think you wouldn't want it underneath 247. That's a pretty good line in the sand for the transports. So right now, so I'm giving you a little bit of an idea of some of the ways I'm following these things. You know, I'm not predicting the prices, I'm following the prices. But I like to look at the general tenor of what's going on out there. Now, something that people are losing money on right now that they're pretty surprised on is in the commodity sector, gold today. Let's go take a look at it and see if there's something to be worried about. Now, again, why should gold go up? Well, historically, my experience, my opinion is that when interest rates are very high, when inflation is very high and interest rates are very low, it generally is good for gold. Okay, because obviously it's a tangible asset. And when your inflation is running higher than your interest rate, it tends to generally cause people to go into tangible assets. The caveat here is because of all the printing money and central bank, funny business with the way they print money, and they change, they buy securities with printed money, or they buy bonds with printed money, their own bonds. It can kind of skew things up because, like, the US dollar right now is very strong. I'll get into that in 1 second. But the US dollar is very strong, which is probably a detriment to gold. And people are thinking interest rates are going a lot higher. That's a detriment to gold. And some people thinking inflation might be rolling over. That's a detriment to gold. So this is some of the reasons why gold had a hard time holding 2000. Now let's just take a look at the trend and see what's going on. On your 20-year average, they're crossing, but they're down here at 1825. So could gold have a correction down towards that number? It could. I'll tell you, the scary thing on gold would be this. You've got a double high up here, and look at that divergence that you would have on the RSI. RSI was up at 73. It made a new high, and the RSI only went to 60. That's a huge divergence, which is indicating that this is a baloney move. Okay. Now, if it breaks under 1820 and your RSI breaks under 50, actually, when and if it starts breaking under 56, I think that might be indicating that something more severe is happening, almost like 2013. So I'd be very careful with the gold right now. It did make a new high, but that relative strength stinks. With regards to the 5-year graph, again, as long as we can hold on the gold at 1938, it's done that. That's a good sign. And again, down here at around 1875. Okay, RSI is looking pretty good. But again, it's coming into that 60 area and it's rolling down. Now, if gold gets above 60 on the RSI, you could accelerate to the upside. Can you see that in 2019, when the RSI got above 60, it accelerated to the upside from 1,400 to 2,000. That's a $700 move. When it got above 60 in 2020, it accelerated up to 2,100. Okay, so getting above 60 is a big thing. If it does that, you'll blow out 2,100 and you'll probably be up at 22, 2,400. So I wouldn't throw the gold out just yet, but I don't know that I'd go all in just yet either. So there's something to keep an eye on. RSI, get above 60 and you're 62 and you could accelerate to the upside. So keep an eye on that. Turning towards the 1-year graph. Okay, this one's, hanging on for dear life. So it's going to be very key to see what happens here. You're at 1962 and 1950. So you're already underneath the 10-day. If this thing breaks under 1950, which it did today, but it didn't close down there. So if in fact it starts closing under 1950, let's look at RSI. Yeah, you see RSI is still above 50. So that's positive. So it's positive. So if it starts getting back above 1963, that might be a train to jump back on because your RSI is in good shape. Your 10 and your 20 are inverted to the upside, but it could break either way. So why not wait for it to break and then go with the flow? So above 1963, under 1950 might give you a better idea of where the next major move is. And on a 1-month graph, you probably got a sell signal here somewhere. Yeah, you got a sell signal up here at around 1990. and that's stair-stepping its way down. So again, what did we say? Get above 1962. Can you see getting above that point is kind of big? And if it does that, then you're kind of back on the thing again. Plus your RSI is under 50 on the short. Now this is a swing trader, day trader kind of deal. So if you get the RSI back above 50, well, do you notice that's where the big run came from? From 1920 to 2000, you got the RSI back above 50. So watch gold like a hawk right now, above 1962 on the monthly, above 60, above 50 on the RSI. This thing could be back on the bicycle. Under 1950, and certainly if it gets under 1940, then that 2000 starting to look like a double top. All right, so that's what the gold looks like. And on the gold stocks, down 5% today. That's no joke. So let's take a look. But I think, it was very overbought. So, from that stand, see like here, but you still never crossed. See, I like to see them cross. Your 10 and 20 have not crossed on the gold. And so there you go. It needs to hold above 33, 34 and change. RSI is good though. But again, once it gets up to that 60 and fails, that's sometimes where there's problems. So gold, like I've already outlined, is in a very, critical area, and we'll see which way it breaks. Silver was trying to get going, got above 25 bucks. I thought it looked good, but now it's under 25, I think, and I don't like that at all. So let's take a look at what it looks like. Okay, silver. Let's go to the 5-year, see what's going on. You see, it's under 25. That's not good. And but again, as long as it stays above, and these are moving averages, as long as it's above 24, and if it gets back above 25, it'd be good. So right now it's moving into where it should be a support zone. The RSI is right around 50. So it's, again, silver and gold, they go hand in hand. And you want silver to stay above 24 bucks, and you like that RSI to stay above 50. That's what it looks like on the 5-year. On the 1-year, it looks like it's breaking down. But again, it's right at 49. So that's why it's key. If this thing can get right back above 25 again, 25.50, that would not be bad. And RSI is right where it should stop, if it's going to stop. And on the 1 month, yeah, it's on the defensive. RSI is on the defensive. So if you're swing trading the thing, you got a sell signal at 26. You should have recognized that one and taken advantage of it. And you got a pretty good ride. Right now, on a very short-term basis here, getting back above 25 bucks is a key. You see that low there? That's around 25 bucks. So getting through that one is kind of a key. So keep an eye on it, 25 cents away from where we are today. Okay, so that gives you a little idea. There was a market that broke pretty good here today also that has been doing very well, and that's in the copper market. Freeport-McMoRan has been a darling because it's just gone up, up, up since it broke out above 10 bucks a share. And I'll show you on that one how that was pretty obvious. Here we go. See, I gave you a buy signal here at 10 bucks, and there's been no reason to sell it. And even now, there's really no great reason to sell it other than when it gets way away from the averages, it tends to come back. So right now, your support is 35 bucks and 41 bucks or 40 bucks, 35 and 40 are your two support zones. So the fact that it came down, 5% today is not good, but it hasn't totally broken the long-term trend. Now, the short-term trend is another story. This thing is coming down. You see, you want it to definitely hold this area around 44. And the RSI is still above 50, but it's pointing down and it's coming off the 60 number. Remember I told you, if it comes off 60, that's not good. And if it breaks in a start, now it looks like it wants to go back down towards 50. The 1 year is the one that broke. If you see this, bam, that's a break. But it broke before and it went right back up. So that's why, there's no guarantee it's going to keep going. In fact, there's a gap there and it filled the gap. You see that gap right there between, I'll tell you the date. You can see it right on your graph. There was a gap there from March 15th. and it came down and filled it. So that's a good sign. If it fills the gap and starts going back up, let's see what it looks like on a 1 month basis. Yeah, doesn't look very good. Even on a day trade. Yeah, it's starting to turn up a little bit on a day trade. But anyway, Freeport-McMoRan got nailed because, again, when they're withdrawing liquidity from the system, it's very difficult for things to go up, because obviously withdrawing with liquidity from the system is trying to slow things down and take excess out of the market. You know, mortgage rates have risen at the fastest pace in history lately. So the likelihood real estate's going to keep going up, in our view, is not exceedingly high. Because if you want to get inflation down, you can't get it down very easily if everyone feels extremely wealthy and they're spending money like drunken sailors and they're accepting price increases with a big smile on their face. That's not the trifecta to slowing the economy down. So if that's what their intent is, and it seems pretty obvious it is, then, you know, things that are based on borrowed money, like cars and houses and many other things, should slow down. Makes logical sense. And again, if it doesn't slow down at this interest rate, they will keep going until it does, or they'll get it at a price at an interest rate and leave it there, and then that'll wear it out a little bit. So clearly, again, things that were going gangbusters are starting to slow down just a little bit. Looking at some of the, now again, we were saying that there could be a situation where some of the commodities could be peaking this year. Let's look at some of the stocks that have gone through the roof and see if there's any vulnerability in the charts. So we'll start out with fertilizers and agricultural type products. CF Industries has had a fantastic run, but you know, fantastic runs don't last forever. And this is where hedging comes in. Can I sell calls against it? Can I sell calls and buy puts? Can I do replacement trades? I mean, how does that work? Well, let's look at a 20-year graph on this thing. Does that look like it's had a big run? Does that look a little overbought? Does the RSI at 71 look like a pretty darn high level? You answer those questions and then ask yourself, is this something that could turn down later in the year, or has it already started? Let's go to the 5-year graph. Look at that RSI. You have a divergence between the high and the second high. So that's not a good sign for the bulls. And that's why we've come already from $114 almost, and we're trading down 14 bucks before you can spell CF Industries. So this is why you hedge sometimes. You hedge because you're trying to protect those values. If you sell a call at 120, obviously you still have potential up to 120. If you buy a put with the premium underneath, then you got protection underneath. That's the concept of hedging. Again, there's a lot more to it than that, but that's a broad stroke concept of what we're talking about. Okay, so CF Industries, and then let's look at the 1-year graph. And then that's a break, right? That's a break. And you got a break here when it broke under 107 and when it broke under 105. So you got a couple of signals that it's breaking. RSI broke 60. Remember I told you if it breaks 60, it's not good. And it broke 60. Now it's going to try to hold 50. If it's still a bull market, it'll hold 50. If it starts breaking under 50 and these things start rolling over, that could mean that we are going to get relief in the agricultural sector. Archer Daniels Midland, very large company, had a big run. Let's take a look. Okay, let's go to the 20-year graph. Does that look like it might be overbought? A little bit on the overbought side. I mean, the RSI is in the blue. Blue means their lips are freezing. It's in an area where you're so rarefied that you turn blue. So it's in rarefied air. And it hit a high price of 100, about, well, let's call it 100. And then it's currently at 96. Let's see what it looks like on a 5-year basis. Again, same story, very overbought, very high price. On a 1-year basis, it's better, is in better shape than CF, that's for sure. But again, 96 and 93 ballpark figures on the averages. And the RSI, again, looks like a divergence, right? This is a high point, and look at all that big move there, and the RSI is much lower. So, you know, certainly shorting it would be extremely risky, probably ill-advised, but doing something to protect your equity might not be so bad. On a swing trading basis, you got a little bit of a sell signal here, but the averages haven't actually crossed, and the RSI is still at 50. So this thing's right on the ledge if you're a swing trader. Again, even when it crosses, you can't trust it. But again, at one of these times when it crosses and they're pointing down, you will get this kind of a move here, like you got from 92 to 86. But, you know, these things didn't cross yet. 94 obviously looks like a short-term support as well. All right, let's look at another one here called Mosaic. Fertilizer. Okay, it looks like it's turning down here on the monthly. On the 1 year, looks like it broke. I mean, the thing lost 12 bucks before you can spell Mosaic. That's why, you know, when things are very extended, look at the 20-year graph again. I mean, the averages are at 40 in the 40s, and Europe it's 80. That's overbought. Like it was overbought here. I mean, obviously it can keep going, but again, at some point it does revert back to the mean. If we were to get a drought, you know, and we still have a suspension of grain, and of course there's impossible to get fertilizer out of Belarus, whatever it's called over there. You know, under circumstances, it could run right back up again, no doubt. But the point being is the reason you do some hedging is to try to protect the values along the way. And again, you can adjust the hedges accordingly as the market moves around. That's why learning how they work is kind of important. All right, so I showed you the agriculture sector where there could be, you know, some froth there. Now let's talk about that energy market, you know. Is Chevron showing any signs of weakening? Let's find out. Look at the 20-year graph. Again, you know, is that extended? 120 is where the averages are. You're up near 180 on a 5-year basis. Again, way over the averages. And now look at that divergence, and it looks like the RSI is trying to roll over. Here you got a little bit of a sell, right? You broke under the averages. They haven't crossed yet, and they're not pointing straight down, so it's premature to call for a huge sustained drop. But again, this is a divergence. You made a high there, and look at the RSI way up there at 80. Now you made another high up here, and the averages were down at 65. That's a divergence, and that's why you're getting this short-term sell. So you got a pretty good sell there. Now on the 1 year, on the 1 month, you probably got a real good looking sell. Oh yeah. So here here's the way it works. You got a 1 move down here into the 170. You got the 2 move up here to the 173. Once you broke under 171, it was lights out. And your RSI is way under 50. So if you're a short-term trader, this was a great one to get short on. So anyway, that's that one. Let's look at the servicers. Is Halliburton Schlumberger following the same suit? They had big runs. You know, believe me, I was bullish on this stuff in 2020 when it went negative $37 a barrel. So I know it's gone a long way. I've been telling people about it for a long time. So if you look at the 20-year, you know, again, you're so far away from the averages. Sometimes it keeps going. There's no doubt about that, no question. But generally, you come back and do a little bit of backing and filling. So RSI on this thing, you know, still, these things are not as overdone as the rest, because you can see on a longer term basis, this thing used to trade at 74 and it used to trade in 60 area. Again, overbought, trying to pull back a little bit. RSI coming off the high number on the 1 year graph. Again, divergence, you know, high point here, and look where the new high leave you, right back down there. And right now it's obviously looking like it's trying to roll over. This 38, 39 area is very important. It stays above. So if it can stay above 39, you're still okay, short term. And on the 1 month, you got the sell signal, obviously on the break here at 41. and the RSI broke 50. So a short-term trader definitely got to sell there. Last time he got a buy was down here under 38. Did he catch a good ride? 38 to 40, well, 3 points on a short-term trade. It's not the worst thing in the world. Okay, so that's the story on energy. And that's the story on the agricultural sector and the metals. That gives you a little bit of an idea there. There are a couple of things in the stock market that we've been following and, people keep talking about. So let's talk about them as well. Financials. Everybody's telling about how great the banks are supposed to do because it's a higher interest rate environment. But it looks to me like somebody's worried about credit risk. And let me explain something that many of you might not get. Real estate's gone through the roof. If you own a house, you know exactly what I'm talking about. Now, a lot of people have bought a real estate in the last few years, right? And they put maybe a varying amounts down. And their interest rates they bought in at are very low. So the banks hold a lot of mortgages, right? Now, if you're holding mortgages that were at a lower interest rate, and now the interest rates are higher, and you have to go sell those mortgages or you have to price them mark to the market on your balance sheet, those are losses. Just like if you buy bonds and rates go up, your bonds are losing money. Well, if you did mortgages and you sold, you're actually selling debt to these people that are buying the debt, and it goes the other way, those mortgages are losing value. Second thing is that how much did people put down? I don't know. Did they put no money down? Did they put 10% down? Did they put 20% down? Well, if the prices went up 20 or 30% or 50% on some of these properties and they back down, say you had 10% down and the prices back down 15%. Is that impossible that we had a 15% correction in the real estate market if these rates, which are already at 5.25, go up to 6 or 6.5 or whatever? Well, what happens if you put 15 or if you put 10% down on something and it drops 15%? You have what they call negative equity. And that's basically what started this stuff in 08. And it started it in 1985 in Phoenix. And it started it in all types of times when real estate goes through the roof and the lenders start getting a little frisky and they start lending high loan to values. And then we get a hiccup and the prices contract. That's when the banks can have trouble. So I don't know if that's going to happen or not. But I do know one thing. These stocks on the banks are not going through the roof as people expected when yields jump like they are because of their free credit income. They're the money they get because of they have deposits they can earn money on. So this is a situation that's interesting, and I'd keep an eye on it. Now, this particular market here, I watch very closely, and as long as if it can start getting back above 38, you see that number where the high is there? If we can start trading back above 38, then I'll buy into the concept and then break 40. I would buy into the concept that the banks are going to do back on the bicycle. But right now, I'm looking at the 20-year graph here. Again, this 38 number, you see, 38. I need it to get above that. Otherwise, there's a risk of going down towards 34. Again, the long term still is okay. RSI is above 50, and that thing is still okay. But the 5-year doesn't look quite as good. See, that's crossed over. And there again, this 38, 39 area, 38, 50, I don't know, whatever number you want to put on it. That's where we got to start trading above, or else we're going to start saying timber if it starts breaking under 36 and 35. And again, the RSI is hanging on for dear life at 50. So I'm not saying get the real negative on the banks here, but I would watch them very closely. And yes, if they can get above those numbers I'm talking about, then I would be bullish on the banks. But right now, my concern is there's a reason they're not going up. And if the reason is that they're concerned about credit losses out of real estate and consumers, which nobody seems to be worried about, because all I hear is how much the consumer is flush with cash and how much he's doing wonderfully and how his balance sheet has never been better. So obviously, it looks so sunny out there, you need sunglasses. But sometimes right before it's that sunny, it starts cloudy, and nobody's prepared for the rain when it gets that sunny. And so the prices sometimes they lead what happens next, right? Because people with more information than us might be putting their bets down, and they don't seem to be betting on the banks, at least not yet. So keep an eye on it and see what goes on. Some of the sectors that have been working this year is in utilities. And you'll see from the graphs here that they are, they've been a good place to park. They're overbought too. So obviously they can pull back. See, they're overbought too, but you can see since January, let's go back to the 1 year. You can see since January, they have been the better place to be, because here you go. This is January of this year, right around here at 66. So not a bad place to be. While people are losing money in stock, these boring people have seen their principal go up and they're getting paid a good dividend. Same thing with some of the dividend paying stocks. So that's what we've been talking about. We would like to be in the areas where the moving averages are under the price and rising. Call us dumb, but that's what we like. And there you go. This is dividend paying stocks for the last year. So in January, they were trading down here at 41 area. Now they're up at 45 and they're paying good dividends. That's where people are rotating. They're not rotating into the we're not profitable, but we'll be profitable in 5 years. They're not rotating into the valuations are extremely high. I mean, let's just, for the sake of it, let's look at Netflix and you'll see exactly why you've been told to get out of that by these averages a long time ago. Let's look at the 20-year on it, and we'll do an analysis on this thing. And you see smart people like Bill Ackman. He's losing $500 billion in the thing or something. Even on the long-term graph, I mean, for gosh sake, it gave you a sell signal once these things crossed at 529. What the heck are you doing in there at 218? RSI broke under 50 in January when the price was up in the 500s. What the heck are you doing on it now? Look at the 5-year graph. 5-year graph. Again, you got sell signals when it broke under 50. That's in the 600 area. So you got a sell signal on the 5-year up in 600. What the heck are you doing in there at 218? And on the 1 year, that thing's been pretty much negative since, again, since the beginning of the year. Once the RSI is under 50, it's negative. Now it got very red here, so you got to pop to get into the gap. But, that was nothing to write home about. It's always been negative ever since it was in the 600-700. So again, it'll be a while before, if you want to play the prices right and play, it might get back into the gap. Good luck to you. If you're doing that, or I was doing that, I would look at the 1-month graph. And I would say that it's above that line there. So what's that number there? 218. So if you can get above 218, 219, and you were gambling, then obviously that would be an indication that it might pop back up. So at least you'd have that to work with if in fact it can get above 219. And then on a 5-day basis, again, getting above 219, 220 would be very nice. And then if it's any good, it shouldn't come back down and get you. And then on a 1-day basis, again, that's too short. But getting above, if you're a short-term speculator, and you're taking a big risk, again, at least there'd be some evidence on the averages if it got above 220, 219, that maybe the thing's turning. Where's the RSI on it? Yeah, see, the RSI is very red. So obviously it's a sold out deal. Some people who like to use a 3-day rule where they wait 3 days, tomorrow will be the 3rd day. So let's see what the 3rd day brings. If it doesn't make new lows after tomorrow or whatever, maybe that might be a sign as well. So a couple of other things that I've been watching here. I'm looking at this infrastructure, and I'm looking at a couple of them because they have different makeups. One is PAVE and the other is IFRA. Maybe there's something here. Let's see. Okay, today it doesn't look any good, but let's take a look on a longer term basis. We'll start with a 5-year graph. Yeah, you see, it's on the edge here. Again, it's not the beginning of anything, that's for sure. But this is the infrastructure stuff, and so it'll have industrials, it'll have utilities in it, and the like. IFRA, utilities, materials, and industrials. And again, you saw Freeport McMoran, so that's materials going down. But again, this one looks a little bit better. If you look at what's inside it, if we're not going to go into a big recession right away or anything like that, this would be something I would keep an eye on. The RSI is right around 60. So again, if it gets above 60 on the RSI, this thing could accelerate to the upside. And your support is pretty close to where the price is, 38.55 and 37.67. International. Take a look at Brazil. Pulling back, but take a look at the, this thing's pulling back, but there's your moving averages turning up, and then your RSI is still above 50. And this thing, used to go, well, let's go 20 years. You get a better idea of what kind of potential could happen. I mean, when was this? Back in 08? In 08, the darn thing was at 100. And as recent as 2020, it was at 50. So that looks to me like it's trying to turn with support around 33, 34 bucks. And the RSI is right at 50. So if this thing can hold its water, and certainly if it can take out this high there could be some potential there. That's Brazil. Let's look at Mexico. These are emerging markets. Latin America. And this is another one. There you go. RSI is still above 50. Trends are moving up pretty good. So while it could get bouncy and stuff, again, this thing used to be at 70 and 80 area almost, and just 57. And again, a lot of people are starting to use these countries rather than the Eastern Europeans because of all the fighting going on and the unreliability of grain, unreliability of energy. So they're going elsewhere. Another one that could benefit is Australia. And this is, again, a country that has a lot of grain, agricultural. And as you can see, the moving averages are starting to turn up a little bit here. RSI is nicely above 50. So again, it's not really breaking out yet, but I would keep an eye on it because these are countries that could benefit longer term. And if you wanted to do something with Europe, it seems to me like the UK, which doesn't have to deal with the euro and all that other nonsense that comes along with it, might be the better way to go if any of them are going up in that area. And right now, it's got most of its support between 31 and 33. And if it got going, you can see there could be some potential, and your RSI is above 50. So there's 4 countries right there that might be very interesting if they get going. Maybe more interesting than ours because ours, are really, contracting on their valuation. One of the reasons people don't understand why stocks are going down after good reports is it doesn't mean they're not making money. It means that we don't want to pay the same amount for the earnings. Meaning, if you are, I'll give you a for instance, if the S&P is going to earn $2.30 this year in earnings, and last year it used to be a 22 PE, that means the S&P could be at 5,000 or better, right? Simple math. $2.30 earnings times 22 to 1 PE, you're at over 5,000. But how about if we contract to 16? Now you got $2.30 and you go 16 times earnings. Now you're at 36.80. So you realize the risk is that the contraction in the PE ratio will offset the increase in earnings and still cause the stock to contract. That's really the risk at the end of the day. And when the rates are rising, that's when the valuations tend to contract. And again, the Federal Reserve does not want hyperinflation. They do not want our houses to go up 50% a year. They do not want $10 gasoline, and they don't want everyone to start raising prices because the public is crazy and they're paying it. So they would like to see things cool off and contract. And again, one of the things they'd like to see contract, in my opinion, is the valuations, which got very, very high. And that's why things like Zoom which we'll show you right now. Why did Zoom come down? They're making money. They're not unprofitable. So how do you explain a stock going from $600 down to $100, which at this point in time might be something to take a look at? Because why? Because the valuations. That's why, the valuations. Snowflake is another one that's out there. And again, why is Snowflake having trouble? Again, why does it go from 430 down to 175? Because I think the valuations are being changed. So again, that's what you have to be careful with. And that's some of the things that you'd have to be on guard. A couple of areas I'm keeping an eye on also is cybersecurity, because everybody is telling me that we're going to be under assault for a very long time. So let's take a look at what CIBR is, just to look at it here and to see if there's something here. Now you see, it is holding the line here. So let's use that 46 number on 46 number ballpark as our line in the sand. And if you want to stay positive on cybersecurity, and on the cloud, again, this one's not looking quite as good, because again, they really broke it. Let's say what it's looking like on a shorter term basis. Yeah, again, so if you can start trading this one above 22, 23, then you could make a case that it's back on the train, and then the RSI would get back above it. But the cloud stocks seem to be in trouble. Again, if we're having a contracting period of time, you could explain that way as well. Also, let's see what some of the big companies like Tesla are doing. Had great earnings, 81% jump in revenue, but let's see what it looks like technically. Because again, it was up quite a bit and it stayed up, but let's see what it looks like. Yeah, see, Tesla has two moving averages on the long term. Well, let's look at the long term basis, 5 years. Yeah, as long as Tesla can stay above 932, $900, 950, okay, you can build a case for it. And the RSI is still above 50. On a short-term basis, let's see if you got a sell signal on it today. No, just came back down. So Tesla above 900, 950 still looks promising. Let's look at some of the other guys that are coming up with earnings. Google, and then we'll shut her down. Google. Again, a lot of people are concerned, like with Facebook, the people are maybe tired of advertising. Maybe they're not getting a return on their investment with advertising with them. It can be very expensive. And if they can't identify that they're actually making money on the ads, maybe they shut them down. This is basically on a sell signal for sure up here in the last month from 2850. Let's take a look at it on a longer term basis and see if there's a support. Okay, so there's your support right there at 2377. You certainly don't want it underneath that level. On a 5-year basis, looks like it's got a lot of resistance above 2665 and 2733. So if they come out with good reports and they rally, look at those numbers. And if they can't get through those, that could be problematic because your RSI did break 50. Turning towards Apple. Okay, Apple on a 5-year, again, is right into a zone here, 166 and 169. It's inverted to the downside. That's not a good sign. And the RSI is still above 50. So again, if we can start getting back above these moving averages, which are what? 160, what? 160, well, probably 167, 170 ballpark area. That would be good. If not, again, could there be a bigger drop coming? Let's look at the 1 year. Yeah, you see they've crossed to the downside. So underneath 168 and underneath 172, you still got to be worried with the Apple. Again, it's holding on, it's underneath 50. So there's your numbers on the upside. 168, 172, you're in much better shape. Start blowing out 165, I think then you got some problems on Apple. All right, guys, we only got a minute to go, so I'm going to tell you how to get a hold of us. Optionprofessor.com. We have a free weekly market update we send out. Obviously, hopefully, if you've been listening, you get an idea that I'm very familiar with all these different areas, and I give you my opinion on all these different areas: stocks, bonds, commodities, and international. That's a lot of information. It goes out free. You put your email in, and then you're on the list. We also have a PDF report that's available on hedging downside risk and upside surprises. And again, we very much encourage you to get that. You can get that by also putting your email in. So go to option, OPTION, professor, PROFESSOR.com, put in your email, you'll be in the queue. We'll get it. And don't forget to put in a valid phone number so we can call you and get you the PDF report. Very important to put in a valid phone number. And then also you'll be put on the weekly update on our market weekly update. Okay. Optionprofessor.com. Take advantage of it, guys. It's out there. I got a lot of experience, a lot of knowledge, and I share it with you each and every week. Okay, this is the Option Professor, thanking everybody for being here. I'm going to now close it out and give it back to David. Thanks, everybody. Good luck and good trade.